that the biggest surprise to us over the since we started our research on Bitcoin into actually 2012, is that stablecoins are starting to usurp a role that we thought Bitcoin would play. We thought Bitcoin would be an insurance policy for emerging markets against confiscation of wealth, either outright or through inflation and other terrible policies. What has happened is the stable coins are taking over. They've hit almost $300 billion. And so we think that that insurance policy role will take $200,000 to $300,000 out of our bull price, which our bull price, of course, was 1.5 million. And we're public with that. That's why I can say this.
Cathie Wood dives into Bitcoin, crypto trends, and her closing outlook on innovation and markets. Let's watch and see what's next.
What is going on? I think it's China, and we saw that exports to China, exports to the United States from China were down 25%. I think in September, they were up 3% to the rest of the world. What does that mean? They're probably cutting prices more aggressively in order to get increased uptake in the rest of the world, given what's happening in the U.S. That's a deflationary impulse, all right. And you can see the green line here is Treasury yields. Why aren't they as highly correlated today as they have been? The high correlation stopped in 22 when the Fed started tightening. Well, maybe if the Fed eases, this will come down more rapidly. And we think it will. And we think the inversion of the yield curve might continue for that reason. Here, for market-based indicators, S&P to gold. This one we've been watching like a hawk. Gold up, S&P wobbly. So you see testing. We do think it's going to resolve to the upside ultimately, especially if the chart I showed you earlier with gold price going down relative to money supply, if that is what happens now. The odds are high that it will happen because, as we saw from that chart, there are only 2 other times it's been this high. So we do not think it's going to resolve like the 70s when S&P fell relative to gold dramatically because inflation was such a problem. We think quite the opposite. Deflation is.
Global money supply is on the rise again, giving Bitcoin a much-needed macro tailwind heading into the end of 2025. Data shows an 8% increase in broad money, M2, since January, showing that liquidity is once again expanding after last year's contraction. This is crucial because Bitcoin often thrives when there's more cash circulating in the global economy. It's a classic liquidity-driven asset. As money flows increase, investors grow more comfortable taking on risk, and Bitcoin tends to capture part of that appetite. The steady M2 growth explains why Bitcoin has held strong near the $100,000 level, even amid mixed ETF flows and volatile headlines. More liquidity doesn't guarantee a rally, but it sets the stage for one by easing financial pressure and supporting speculative assets. The connection between monetary policy and crypto remains tight. As long as central banks keep signaling stability and avoid sharp tightening, Bitcoin's floor looks solid. With policy steady, liquidity rising, and confidence returning, the world's top cryptocurrency may have the support it needs to sustain its position and potentially climb higher into 2026.
But that was in an all other things equal world. What has also happened, of course, is what we've been discussing. The gold price has doubled. So the gold market cap has doubled. And part of our analysis for the potential for Bitcoin was that maybe it would become half the market cap of gold. It would take some share from gold or maybe expand the market. Well, that market has doubled. I don't think our bull price should change all that much. And I probably should have been quicker to say all things equal on CNBC the other day. So I just wanted to clarify that. We are very bullish on crypto assets, but we know that they are the most susceptible to liquidity drawdowns. And I described earlier, we have a number of reasons for liquidity drawdowns now, but we think that they will be cleared by the end of the year, and hopefully by December 10th, when the Fed eases, and hopefully when government statistics come back and we get the employment report in early December, which is the next time that I will have the pleasure of doing In the Know. So hopefully we're in the clear by then, and the bull market that we believe is firmly in place will continue apace.
A new tool called the Quantum Doomsday Clock is sparking major debate in the crypto world. It predicts that quantum computers could be powerful enough to crack Bitcoin's encryption by March 8, 2028, just over 2 years from now. Created by cryptography expert Dr. Richard Carback and entrepreneur Colton Dillion, the tool calculates when a cryptographically relevant quantum computer could use Shor's algorithm to break Bitcoin's elliptic curve security. The model suggests that only around 1,673 logical qubits could be enough to expose private keys from Bitcoin's public addresses, putting older wallets and reuse addresses at serious risk. However, newer formats like Taproot and SegWit would remain safer for longer, since they hide public keys behind hashes. Experts are divided on how soon this threat could materialize. Some, like Adam Back, believe we're still decades away from real danger, while others, including David Carvalho and researchers at the Global Risk Institute, warn that breakthroughs could come much sooner. With IBM and Google racing toward fault-tolerant quantum computers by the decade's end, Bitcoin's encryption may face its ultimate test sooner than anyone expected. If you have been watching so far, thank you so much for watching, and do not forget to subscribe to Bitcoinzilla for daily news, all for free. That's all for today's video. Until next time.